It is impossible to talk about investments and not mention about mutual funds. And why not? It is one of the most popular ways of investing in today's time. Hello and welcome to the Economic Times. I am Neha Vashisht Mahajan, and in today's episode we are going to talk all about mutual funds, how they work and what you need to know before investing in one. Let's take a look. Gone are the days when our parents used to put all their savings in an FD, a bank account or a PPF account. Today's investor wants more. The investor knows that in this fast-paced world, with inflation and elevating lifestyles, the needs of today's investor cannot be met without proper planning. This is where mutual funds come in. So let's start with the basics, and that is, what is a mutual fund? Now, as the name suggests, it is a mutual fund, a pool or fund managed by a professional fund manager, a trust that collects money from different investors and invests the same in equities, bonds, money market instruments, and other securities. For example, let's say there is a box of 15 bananas worth 100 rupees. Now, a group of 5 friends decides to buy the bananas. Everyone has 20 rupees. The shopkeeper says, I will only give the whole box and won't sell it separately. So all of them pool their money and buy the box. If we divide as per each person's investment, each person gets 3 bananas or 3 units each. This means all get their share and are part owners of the box. The same happens in a mutual fund. It's just that the investment grows over time. Now, there are a lot of terms that you might come across while investing, such as AMCs, expense ratios, etc. So let us also understand those. Starting with AMCs, what are AMCs? Companies that qualify to set up mutual funds. They build asset management companies, and we know them as AMCs, or fund houses also. These AMCs pool the money from investors, market mutual funds, manage investments, and enable investor transactions. Now, who are fund managers? Professionals who manage mutual funds are called fund managers. These professionals have the expertise in analyzing and managing money. They invest money in different assets such as stocks, bonds, etc. Where to invest and when to invest is their prime agenda. Now, what is an expense ratio? It is an annual maintenance fee that is required by mutual fund houses to manage a fund. AMCs charge a fee, and that fee is called the expense ratio. It is not fixed and varies as per the fund. Now we are going to talk about NAV. So what is NAV? NAV per unit is the price at which you buy or redeem units of a fund. For example, if you invest 500 rupees in a mutual fund with an NAV of 10 rupees, you will get 50 units of the mutual fund. The NAV of the mutual fund changes daily based on the performance of the assets that the mutual fund is invested in. If a mutual fund invests in a particular stock whose price goes up tomorrow, the same will reflect in the NAV of the mutual fund and vice versa. Now, what are the ways of investing in a mutual fund? So basically, there are 2 main ways to invest. Number 1, lump sum, and number 2, SIP. In lump sum, you invest a big amount as one-time investment. Generally, people go for lump sum when they get a big amount from the sale of any assets or they get a big bonus. In an SIP or systematic investment plan, you pay a fixed amount at regular intervals. That means you can automate your investments as monthly, quarterly, etc. It also comes with a feature of rupee cost averaging that averages out the cost of units purchased. So in a nutshell, you do not have to time the market in this. Now, what are the types of mutual funds as per asset classes? Number 1, equity funds. These funds invest majorly in stocks. Under this, you get large cap, small cap, mid cap, and multi-cap funds along with many others. Number 2, debt funds. These funds lend money to corporations and the government by buying their debt papers. Under this, you get money market funds, bonds, liquid funds, etc. Number 3, we have hybrid funds. Now, these funds invest in multiple asset classes such as equity, gold, and debt. Under this, you have options like an aggressive hybrid, dynamic asset allocation, arbitrage funds, etc. Now, you must be wondering, how are these funds useful to me? Number 1, you get liquidity. Mutual funds have higher liquidity. You can easily buy or sell them. Number 2, you get better returns. Historically, returns on mutual funds have been higher in comparison to FD, RD, PPF, etc. Number 3, mutual funds give benefit of low investment. You can invest as low as 500 rupees too. Some funds even give you minimum amounts as low as 100 rupees. Lastly, number 4, you get diversification. You get diversification in your portfolio as many mutual funds invest in bonds, stocks, etc. This reduces risk. So this was all about the basics of mutual funds. We'll see you next time in our next episode.